no kind of net increase. They're going to have to earn even more. They're going to have to go into even more debt. So the rising house prices do not create additional net GDP value to the economy. Actually what they do is they redistribute wealth towards those people who already have houses, i.e. wealthier people, and remove it from poorer people who can't afford to get on the housing ladder. So it's another example of a very regressive policy, actually, to allow house prices to simply inflate. It makes everybody feel kind of like things are going well, and people spend more money on other stuff. They take equity out of their houses, but it's not creating new jobs. It's not enhancing the quality of the economy. It's not helping our balance of trade. It's not helping the public deficit. It's a zero-sum game.
As of August 2011, 85.5% of consumer bank lending was secured as mortgages on dwellings.
If you have somebody creating money that can only be spent on one thing, which is housing, then the price of that thing is going to go up. Between 2000 and 2010, they created over £1 trillion of new money, £500 billion just in the 3 years before the crisis. That's why house prices went up the way they were. There's nothing, special about houses. It was just all this funny money being pumped into that market.
If money is spent into the economy, into a lot of money goes into houses, for example, into mortgages, that's an increase in the amount of money in the economy without a corresponding increase in activity, in output, in GDP. It's non-GDP based spending. That's what causes inflation, and in the UK we've had it in spades. We've had this massive housing boom, and the main cause for the housing boom, in my opinion, is the huge amount of speculative credit created by the banks to go into houses. If houses were cheaper, they would be easier to build. More of them would be built. There would be less huge houses with hardly any people in them. London would not be the centre of a kind of very rich speculative orgy where all the richest people in the world want to get a property in London because it's seen as a great asset. Houses would be seen as places to live primarily rather than places to invest. Important thing to think about is if you're a bank and you've got to make a loan, you have choices. You can give that loan to a small business, and you'll know that the risk to you of that loan failing, defaulting, is actually quite high because that small business, the owners of that business, have limited liability, which means if the business goes bust, you as a bank are getting nothing back, essentially. That's it. So that's kind of high risk compared to loaning your money to somebody with some collateral, with a house behind them, like a mortgage. So there's a kind of simple incentive for banks to prefer putting money into housing than into a small business. Now that's a real problem, or if you widen that out across a whole economy, because it means there's an incentive, to put money into speculative rather than productive investment. So again, we have to think about how we create a monetary system that is more balanced between those two kinds of speculative and productive investment. The government showing very little, enormous reluctance to regulate the housing market and to, again, regulate the amount of money that banks put into houses.
We don't decide who creates credit for what. No, we leave that to a couple of chaps in a bank to decide, basically.
A bubble occurs when there is very high inflation in the price of a specific good or service over a short period of time.
The idea of the tulips and their relevance is that we saw the first ever financial bubble and crash. The craze for tulips, black tulips being a mythical ideal of what somebody could genetically engineer through cultivation after many generations, became a mania in the Netherlands in the 1630s. What they didn't realize was that many of the very, very rare patterns on tulips were caused by a virus and weren't genetic at all. But they traded in them, to the extent that tulip bulbs got to the point where they were worth 10 times the average annual salary of a person working in the Netherlands. There was a futures market in tulip bulbs because obviously you plant them now, but you don't know what's going to come out the ground. So we see already 400 years ago that a money system or a financial system is not something that exists in the abstract, somewhere out there in the ether, but something that was to do with states, power, trade, and how they interact with each other.
Unlike tulips, which are a disposable luxury, houses are both a necessity and a luxury, and as such, they are ideal as a vehicle for money and bubble creation. A dwelling is perhaps the most prized possession of value most people aspire to. Inflating house prices in this way allows a nation to expand its money supply without affecting inflation data. The additional purchasing power created increases the perceived wealth in relation to other nations, and thus it creates relative power. It is a way of increasing monetary power without investing in the productive growth of industry.
But certainly if you look at Britain and America as outstanding examples of this, these are countries with very high rates of private home ownership, so you've got a good base to try and perform this sort of policy off the back of. I think it was quite deliberate in the case of the US, almost explicit. It was Alan Greenspan, as head of the Federal Reserve, when confronted by a stock market crash at the end of the 1990s, quite deliberately slashed interest rates to almost zero. Everyone can borrow very, very cheaply. In particular, it's very easy to borrow against a house because this is an asset and it's potentially something that a bank can say, well, okay, we're not just lending you money unsecured, you actually do have a house, and that's great because we can repossess it. They won't tell you this when you take the mortgage, but they can do this. And that bubble is then what fuels expansion, such as it is inside the US and inside the UK, where something similar takes place for the next decade or so. I think it's also a reflection of an underlying weakness of these governments, that they simply lack the will and possibly the ability, but I think it more comes down to a will to challenge financial markets, to challenge big capital and say, we're going to do something different now, and you're going to have to go along with it, because we've been democratically elected and you lot frankly haven't, and we have a mandate to do this and we're going to make this happen.
Just remember, it's all part of the plan. What are you yapping about? You voted for it.
In Holland, or in the Netherlands, what we had over a period of trying to get independence initially from Spain and trying to raise money to get an army to free themselves was financial innovation. They innovated public lotteries to get money together. They had public subscription. This was the idea that led to the idea of public shares, a piece of the action that anybody could invest in. That meant that something like 2/3 of the population was investing in tulip bulbs by the 1630s. After independence, these instruments were applied to financing expansion. Why was such a small country able to hold its own against so much bigger countries? For example, Spain and Portugal, that had the benefits of their empires for over a century in respect of the Netherlands. Why could they compete? On what resource basis? Well, they had a more efficient, a more involved, and a broader-based financial system with these instruments that they'd innovated that allowed them to bring more money to bear at one point than anybody else more quickly.
Incredible, but true.
Now, inflation can be avoided if the amount of money that goes into the economy is regulated in a way that it doesn't exceed the actual activity that's happening in the economy. Now, the best way to do that, in my opinion, is to make sure that money is issued into the economy only for productive investment, for productive goods and services. So money goes in to help a small business start up, which creates jobs, which creates additional purchasing power, which means there's no inflation.
During their history, almost all central banks have employed forms of direct credit regulation. The central bank would determine desired nominal GDP growth, then calculate the necessary amount of credit creation to achieve this, and then allocate this credit creation both across the various banks and type of banks and across industrial sectors. Unproductive credit was suppressed. Thus, it was difficult or impossible to obtain bank credit for large-scale, purely speculative transactions, such as today's large-scale bank funding to hedge funds. The World Bank recognised in a 1993 study that this mechanism of intervention in credit allocation was at the core of the East Asian economic miracle.
There's all sorts of things that governments have done in the past, very successfully in a number of cases, and often not unsuccessfully in this country, but the examples that spring to mind, like South Korea, Japan, often in East Asia, where governments have been quite targeted about how they're going to rebalance the economy and picking sectors and deciding where the investment should take place. I think that has to start happening in the UK because we're in a demand-side recession rather than looking at a crisis of supply.
You have to have a system where credit is put into productive avenues, where credit is put into building high-speed rail links, where credit is put into building houses rather than giving people money to inflate the price of houses. So it's quite simple, really, in that way. The current system is simply set up not to do that, basically.
The creation of money by private banks for non-productive usage causes real inflation, and as such it is a tax on the purchasing power of the medium of exchange.
The figures for the UK are quite stark, actually, that average, median, real incomes so that's, what, the bit in the middle, for most people declined over the last 8 years or so. They're now in quite sharp decline as we go into the recession. I mean, the sharpest really since about the 1930s, put it that way. So real incomes are declining.
Bank-created fiat currency allows the private banks to suck wealth from the economy, and over time results in a gradual decrease in the standard of living. As people become poorer, they become even more dependent on debt. And this at a time when efficiency and machination have improved dramatically.
You go back to the 1960s, and we were expected we were looking forward to an age of leisure. They were talking television programs saying, what's people going to do with all their spare time? And now we've got more people working harder than ever, spending more than ever, which looks great. Everyone's spending more. Everyone says, oh yeah, But if you're not actually benefiting from what you're spending, if you're having to spend the money on childcare costs, on commuting costs, and so forth, the costs that people didn't in the past used to have to pay, because you could walk to work, and one member of the family was able to stay at home and be a permanent homemaker, then you're not actually any better off. Everyone's under such enormous pressures nowadays. I am conscious that, my 4 nephews and nieces are facing difficult times. Just going to find themselves having to work, very hard, just to keep a roof over them, just to get a roof over them, just to keep a roof over their head.
People are getting poorer in real terms. It's because prices are always going up, because all this new funny money is being pumped into the system by the banks, and they're creating it all as debt. So at the same time as prices are going up and things are getting more expensive, we're getting further and further into debt, and our wealth and the return that we get from actually working is getting less and less all the time. I mean, you can't deal with poverty when you have a financial system and a money system that distributes money from the poor to the very rich. Any distribution that you try and do in the opposite direction is, it's effectively pissing in the wind. If you look at issues like, increasing inequality, one obvious way to tackle inequality is to have, say, for example, a redistributive tax system. You tax the rich, you give some money to the poor, you move a bit of money down the scale. That's all very well, but if you completely overlook the fact that there's another redistributive system which is taking money from the poor and giving it to the rich, then you're not really going to tackle this inequality. And the way a debt-based money system works, it guarantees that for every pound of money, there's going to be a pound of debt. Now, that debt is typically going to end up with the poor, the sort of lower middle classes.